Okay, we're gonna start, and I'm sorry I'm back. So the bad news is I'm back. The good news is I'm back as a moderator, so I'm not gonna talk much. And I am delighted that we have two very special people on this panel to talk about investing in emerging markets. On my left, immediate left, Rebecca, who's the head of international research and strategy at Nationwide Investment. She brings a wealth of expertise and her comparative advantage, they both have absolute advantages, but her comparative advantage on this panel is the top-down view of where emerging markets fits in an overall asset allocation. Next to her is Robert, the founder and CIO of Gramercy, a very successful, bottom-up driven emerging market hedge fund that I have gotten to know and appreciate and respect and work for even more in the last few months. And he's going to provide the bottom-up complement, but both of them are going to talk about top-down and bottom-up coming together and what does that mean for emerging market investment. The narrative arc of the discussion is we're going to start with the general investment environment. Where does EM fit in all this? What in particular makes sense and doesn't make sense in EM? Then we're going to turn to you to see if there's any questions. If not, I'm going to continue asking questions. And then to have some fun and put them on the spot, I'm going to play a long, short game with them at the end. We're going to go till 9:50, and if I look at my phone, I'm not checking about where my daughter is, although I would love to. Okay, but I don't have a watch anymore. Okay, so Rebecca, let me start with you. From yesterday, from today, we're coming from a world that at one point was unthinkable. We're coming from a world of 15 to 17 trillion of negative yielding bonds. We're coming from a world where investors have made money both on the risky side of the asset allocation and the risk mitigation side. Okay, you've been paid for both, which is great. We're coming from a world where we could rely on ample and predictable liquidity from central banks. How do you interpret the world we've come from? Where do you see us going, and what does it mean for how you think about asset allocation at Nationwide Investment?
Thank you. I'll keep it focused on emerging markets. Let me describe to you a world that we're actually really coming from. China growing at 10 to 14, 15% growth rates in certain years. A commodity boom that had been focused on really one thing, the rise of emerging markets, the support of commodities. So any resource country could benefit from that, resource corporate could benefit from that. Accumulation of reserves, a shift in issuance from hard currency as reserves were topped out to local currency, better financial systems, better liquidity. And then the environment changes. We have hit a global macro political, geopolitical shift in the tone. And at the same time, the market structure is shifting. The Fed, global central banks are buying debt, pushing the likes of us out to find other opportunities, whether that's less liquidity, lower credit, or trying to give on liquidity and maintaining good credit work. We're in a pinnacle period where we're trying to figure out where is the future of emerging markets. It's not a one-way street anymore. It's not just anybody tied to resource boom or China. China's restructuring, and at the margin, it's going to slow. Growth is going to slow. They may be opening up their capital markets, but the macro implications are very different compared to the way they used to be. Is the issuance pattern going to be so robust? Will it move in that structural trend of more local currency, better financial systems? You know, I don't know. I do know that there is a test on valuations. The central banks are in there. The global emerging market landscape has benefited, absolutely. We're interested in doing where I think the asset class is going to become more idiosyncratic. It's not a one-way street anymore. Do your bottom-up credit work. That's what we're trying to do. What we've started to do, we're very domestically based, and we're trying to move it internationally to get some diversification. We're first starting to understand how the world around us impacts our US domestic assets. Then we can start to understand what an emerging market looks like. So bottom-up credit work, more idiosyncratic, not an asset class trend. that's the way that I'm looking at emerging markets in this landscape.
So let me ask you one follow-up question before I pass on to Robert. This notion of it's no longer a one-way street, but we had this wonderful secular tailwind that has stopped. I'm often struck by this statistic. If you had invested in the S&P in 2015 and sold a few months ago, you would have made 160%. If you had invested in EM equities, EEM, and sold, you would have made 0. So how do you bring in valuations for someone who's very naive, says, well, everything you say is right, but look at the valuation differential. Surely it's time to fade the US and go into EM, regardless of whether this tailwind has ended or not. What do you say to them?
Personally, I would agree. The strength is in EM. The growth is in EM. I mean, just ostensibly looking at the potential returns. You mentioned social returns. I mean, there are huge social returns to just simple reforms. We've already started the low-hanging fruit. There's more difficult reforms ahead, but I would agree with that. It's not that you can just get into any EM market. I think there's going to be a differentiation across the asset class, even within different currencies, that you need to. We were talking this morning at there's been secular trends that have defined a macro strategy, especially in asset allocation, without a clear knowledge of what the next 3 to 5 years is going to look like. It's hard to invest in just EM as an asset class. So what I'm suggesting is I agree. There's lots of diversification benefits getting out of the dollar, getting out of U.S. assets, getting out of developed market assets, especially negative yielding ones. But the work needs to be done. I mean, the big economies in EM are, China, India, Brazil, Russia. Make your bet across those. That's what I'm suggesting. It is a country selection these days, I believe, at a macro point of view. It's no longer an asset class selection.
So Robert, two hypotheses for you to react to. One is no longer a one-way street. 2 is that means that the investment opportunity is not the asset class as a whole, it is selectively within the asset class. Can you react to both?
Sure. And they're obviously correlated, but I would agree with this notion that this label of emerging markets is a bit intellectually lazy. I've been in the asset class actually since before it was an asset class, and then they just called it EM. And it was kind of risk on, risk off, and it was this appendage, and you didn't really get paid to think about differentiation within emerging markets as an asset class. So we think about it in the way that we've evolved our platform is around the different return streams that are available in emerging markets, and to think of emerging market return streams on a blank piece of paper and then see where the best return is relative to an objective and relative to the risk that you can tolerate. But people always ask me, where do you invest? Do you do emerging markets? And I take kind of the old world approach, which is I don't want the World Bank or Goldman Sachs or someone else, or JP Morgan to tell me where I can invest because they've created an index. But I kind of look at the still what I call the former Soviet Union and Eastern Europe, Asia, and Latin America, and then dig in. Or people like to use terms like frontier markets. Well, everywhere that you and I have ever invested at one time was a frontier market. So I don't want to eliminate things just from the sake of labels.
So one of the issues with emerging markets has been the structural imbalance between the dedicated investors who think like the two of you, and then the crossover investor who thinks much more generally, and these days increasingly has come in through index products, through low-cost index products. Speak a little bit about what does that mean for the world you live in? To what extent is that a frustration, or is that an opportunity?
All of the above. So, having spent 32 years in emerging markets, and we've been talking to this conference for the last 2 days about global liquidity and how many dollars are floating around. And I'll just stop and say that in the 32 years, it's certainly in the past 25 years, I think emerging markets fixed income, particularly in corporates, is potentially as illiquid as it's ever been, right? And then now we have to talk about where that risk resides, where it used to be, and where it is today. So if I go back to emerging market corporate credit back, before the crisis, it tended to reside in a 90-day vehicle called a hedge fund. And post the crisis, allocators said, whoa, that 90-day vehicle, way too liquid for the underlying illiquidity of the emerging market corporate debt. So we're gonna redeem, and we're gonna go do something safe. We're gonna get liquid, and we're gonna go buy ETFs. We're gonna go buy UCITS, and we're gonna go buy 40 Ax. And what do? As we were liquidating the bonds, they bought those same bonds and put them into one-day vehicles. So we went from 90-day money to one-day money. But that's only part of the story. The rest of the story is, since 2010, emerging market corporate credit in CUSIP form is about 5 times larger than it was. Today it's 5 times larger than 2010. And the street, there used to be this notion of broker-dealer. Well, the D's gone. Everybody's a broker. And we're not really seeing the impact of it yet, because as the market has grown, there's been inelastic supply. At every price, there's an issuer that's always willing to take money from the market. And we take somewhere like Brazil, and they've issued at 4%, and they've issued at 14%, and everywhere in between. But demand itself won't be inelastic when there are outflows, and there will be outflows. And there's this complacency out there as though the current allocation is the one that everybody's going to keep forever. What I'm concerned about, and also excited about, is this dislocation that's going to occur. And as you were saying in your previous panel, if you understand that, you embrace it, and you underwrite it today, there's a huge opportunity. And we call it, plan the trade and trade the plan. But wouldn't you have liked in 2006 and 2007 to have calmly underwritten the credit crisis, said this is silly, this can't go on forever, I don't know how long it'll go on, but in March of 2009, to have some sort of drawdown structure in place where you plan the trade the plan, and all the psychology's out of it, and that you pre-committed your governance committees to that structure, that to me is, following up from your conversation this morning, how to embrace the volatility.
So Rebecca, talk about that. In particular, talk about it in the context of a traditional governance system where you have very well-defined asset classes, right? And we heard 2 things, is EM is no longer a simple asset class. It has features that go all over the place. And 2, and I don't know whether you agree with Robert, but this powerful notion of his, of illiquidity in the midst of global liquidity. How do you talk to people who are conditioned to think in a certain way?
Well, it's funny because we put our, at Nationwide, we put our EMD products into a class called liquid alternatives, which is just silly to me. EMD, even in the past, to me, does not seem to be all that liquid, especially when you want to sell, or you never need to buy. So we've already kind of come to the understanding that EMD really isn't all that liquid. And I agree that it seems, especially if the asset class is no longer going to be on a one-way street, it's going to be more idiosyncratic, you're going to need to find those pockets of liquidity. We are actually, our strategy is more barbelled in the way we think of liquidity in investment-grade corporate public credit markets, and then we've got a slew of asset classes that are very illiquid, that we're very comfortable with our bottom-up credit work. EM, though, I think is very prone to these gaps in liquidity and this very quick repricing. And it's just because the market structure has changed so much. Where is the lending coming from? Where, what is the actual real debt load? I was just reading a Moody's report, and they had increased the number of sovereigns that were rated by something like 100 to 106 just over the last year, largely in Africa. Africa is the growth story, population growth. They've got resources. If they just reform, every single one of those in the public markets on the sovereign side, every single one of those issues are oversubscribed. They just can't issue enough paper. People want it. And I think there are pockets of areas of the world, even in emerging markets, whatever that, I like to call it what the World Bank calls it, low and middle income countries, where you are going to be susceptible to poor credit work done along the way. And I think over at the Kiel Institute, they've done some really neat research on China's capital lending programs and global capital flows. And I'm sure you're familiar with this, but basically there's a whole ton of hidden capital coming from China, and they estimate on the low end around 200 billion through 2016, and we've had 3 years since then. These are hidden debts. This is not measured by the rating agencies. This is not measured by the IMF, the World Bank, because China's not part of the Paris Club, so they don't have to. They have reporting seats. So I think there's all sorts of skeletons that will come out of the markets, and that is in the emerging market space, and come out of the closet. And I think, again, if you just do the credit work and you understand that there are skeletons, and you can sit through the liquidity events, you're going to be confident in the credit work that you've underwritten going into it. And I think that's one thing we talked about this morning that I was very attracted to in terms of your opportunity set at Gramercy.
And I think the barbell that you spoke of is the way that we're thinking about it, which is, and we heard all day yesterday that people need return. So you need to take risk to get return, but you need to take intelligent risk. And I think the intelligent risk in emerging markets today is to, one, if you've got illiquidity in your portfolio, make sure that it's your potential liquidity that you've underwritten high quality credit and probably with short duration. I'm not saying you have to get out of every CUSIP in your portfolio, but to the extent that you really don't need one-day liquidity, you can move out the illiquidity spectrum. And when you talk about equity returns, if you were sitting in private credit contractual income in emerging markets over that same period of time, you may not have kept up with the S&P, but you definitely kept up with the returns that your endowment or your pension fund needed. But so I think that the barbell that we're thinking about is underwrite, take down the risk that you really get paid. And for me today, that's private credit in emerging markets. Talk a little about that. You get much higher yields, you get explicitly paid for the illiquidity, and you get less risk because you have great security packages. And then the other part of the barbell, which is kind of embracing that dislocation before it occurs, having some cash, having the courage to have some cash, understanding the option value of cash. But then let's unpack what those dislocations have looked like and what are the return potentials that have come behind them. And I think it's fair to assume that there's been 9 in the last 20 years. The peak to trough's been down about 20%. We're talking about bonds here, fixed income, liquid bonds in emerging markets. Peak to trough down 20% in 5 months. In 12 to 24 months, the returns have been 30 to 50%. Now, I personally think it's those returns at that part of the cycle that are not only obviously the most interesting, but the ones that have driven a lot of capital into long-only emerging market debt. So I'd rather like to think about countercyclical and underwrite it before it happens. It's going to happen. Just like the taper tantrum. We did the same thing before the taper tantrum. Underwrite it, it's going to happen. When it happens, you calmly take it down, and you're pre-committed. Because I started my firm during the Russian debt crisis, and I ran around and told a lot of LPs, a few in the room here, that Russia's really cheap at 6 cents, and most of them were under the table, licking their wounds. You couldn't get them on the phone, and you couldn't get anybody on the phone in March of '09. So what I'm saying to people now is let's have the conversation now. It's calm. Let's underwrite it. When it happens, let's take advantage of it.
So there's a reason why you can't get them on the phone, right? So let me take 2 examples that you've cited previously. I've heard you cite them. And how do you explain them? Because on paper, they make no sense. One is Mexico. You have a choice. Either you lend to Pemex via the public markets at 4%, or you can lend via opportunities that you source at double digit with better collateral, okay? And yet, this is crowded, this is not. Argentina, the 100-year bond at 7.25% was oversubscribed. At 30 to 40 cents, no one wants to touch it, okay? So talk a little bit about when you're sitting in front of people and they see these big contrasts, how do you explain to them to get over the behavioral challenges that make you do the wrong thing at the wrong time?
Yeah, we typically talk about
and then I'm going to come to questions, by the way. So
we talk about, and those situations are a little bit different. There's something broken. There's some element of distress. And for something to be cheap, not just cheaper than it used to be, you have to be able to clearly identify, like, what's the element of distress. And then number 2 is, like, what's the catalyst that's going to change the element of distress? Because things can stay cheap for long periods of time. And you talked about Greece at negative yields a while ago. Well, there was a time that Greece was trading at 60 and 40 cents, and people would come to me and say, it's cheap, and why don't you get involved? And I said, well, it's just cheaper than it used to be, because when you run a debt sustainability analysis, this is a 20-cent asset. So in the case of Pemex, 4% for liquid credit versus 15% or 17% for illiquid credit, I think part of it's the way that the markets are organized today, that everybody has to, quote, stay liquid, and they're not allocating some capital towards the illiquid. But what's broken is the banks, the prop desks. We used to compete with prop desks on every desk on the street, and they would crowd us out. Now they're not there. And we talked about Turkey earlier too. It's like you can write mid-teens paper in Turkey only because the banks that used to spoil all the borrowers there aren't lending anymore. So that's something broken there. When you take the case of Argentina, Argentina is this feast or famine asset, and it's a great example of what we've seen in emerging markets for long periods of time. But I also think it's a good indicator of what you can expect as I've talked about these dislocations. At the first part of the cycle, when it was trading at 40 cents, the real money long onlys of the world didn't want to participate in it. I think you even said maybe it's one of the most painful things not to have in your portfolio at one period of time. Nobody wants to have it because all they're seeing is yesterday's risk, and they're not seeing what they're getting paid for it. Then you get the transformation, and you get the 100-year bond. When they issued that 100-year bond, they'd been in default in 29 out of 35 years. That's when we decided to return about $1 billion of capital to our LPs, and we said, you know what, it's kind of over. That 40-cent bond's now trading at 118. We'll give you a call when it's back. And I think the other factor is.
Did you make the call?
We did. We did.
And what sort of reception did you get?
About 2/3 of it's come back. So look, I mean, that's the way we've thought about emerging markets. It's a dynamic asset class. I don't want to and multiple return streams. But for us, it's not about let's be in Argentina forever. It's not. It's there's times where it makes sense in absolute terms, and times when it makes sense in relative terms. A 100-year bond at 7 1/8, trading up to 105 made no sense to us. That same bond trading sub 40 makes a lot of sense to us.
Questions? I can go on, and we'll go on. Questions? Go ahead, please, sir.
Robert, yesterday at a roundtable, you referred to a concept called credit culture. And looking at credit culture when you're selecting what investment in emerging markets to invest in. Could you elaborate on that? Because I thought it was an interesting
So
insight.
let me just repeat the question for people. Speak to this notion of credit culture in emerging market investing.
Yeah, that's a great question. And I think emerging markets credit is like all other credit, but then there's a lot more work. And I think at the end of the day, you're underwriting people. And we talk about jurisdiction. Is it under New York law or UK law or what have you? What are the collateral structures you have? But all that's a risk mitigation tool, a risk management tool. If you make a mistake on people, so the first thing we think about is who are the people that we're lending to. Whether that's who's the president, who's the CFO, who's the CEO, who's the family behind it. What has their behavior in the past been in times of duress to predict how they may behave in the future? And that's all analysis of people and the notion of culture. And sometimes I'm too tight of a bias on credit culture, but you have these tire treads on your forehead that remind you of mistakes you've made. And I still think of Colombia as a culture of payment. They pride themselves on the fact that they didn't go into the Brady debt restructurings when everybody else did. And I can still see that in corporate obligors today in conversations that you have. We talked about Mexico yesterday. I think it's a culture of collection. If you work the credit and you have good credit rights, you'll get paid. It may take a little bit more work. We've been in other jurisdictions where maybe credit culture is an oxymoron, where ultimately they can have a bankruptcy that occurs in a remote place, that creditors aren't present, and you read about what you're getting in the morning. I'm not interested in that culture. So I think at the end of the day, if you do your people analysis right and your culture analysis right, then you don't even have to rely on the jurisdiction and the collateral.
And Rebecca, how easy is it to judge credit culture?
Credit culture, I think, is very difficult, especially in this shifting political environment from the top down. We were talking about earlier just how you were just brought up the example of CEOs being kind of heavy-handed into acting or running their business in a different manner. That's going to filter down to the culture of any corporate. I will say we look to corporates as a spread above. We like the spread. We are more confident in the ability to assess a corporate structure rather than a sovereign structure. And so we do believe in the future of emerging market corporates. On your point about ability to strategically react to gaping liquidity events, we're good at not selling. We have a very well-defined investment thesis, and we're confident where we are. But taking advantage of the gape events is proving to be more challenging for us since we don't really know where we are. So we know where we've been, but we don't know where we are. So therefore, how can we be confident about where we're going? And from an investment strategy point of view, I think that is difficult, and it creates asset allocation at a very broad level. That makes it a little bit problematic in terms of having confidence. So we're increasingly looking to the bottom up to understand where we are and where we're going to go. So that's earnings, that's cultures, that's really relying on the bottom up more so than I ever have before.
And I agree that we don't know where we are, but we can plan for different places that we might be. And Mohamed, I know you like football, even though it's a challenge of years it's been for the Jets. But
You had to say it. You just had to say it, right?
the 49ers are 8-0, by the way.
Yeah.
They're back. But the PMs in the room that are with me, they know that when I hire them, they get the wristband that the quarterback wears. And it says plan the trade and trade the plan. And the idea is that you open it up. We don't know where we are, but we can make plans for, if it's 4th and 1, if it's, 2-minute drill, so that when we get there, it's just calm. They only have 30 seconds to get the ball off, right? We're the same thing. And when that, these V-shaped recoveries happen very quickly. So I don't know what it's going to look like, but I could set up plans for different places that we might end up. And that's what I'm asking LPs to do at the same time is think about it now. And let's put the wristband on. And then when we get to, 3rd and 10, we know what to do.
Okay, there was a question there. Is it still there? No. Okay, we have one here. Before that, let me just say that the Jets have a very easy answer. Just give the ball away. You don't have to worry about what comes next. Please, sir.
One of the really instability and driving to bimodal world is that because technology, especially in the specific technologies in the area of digital transformation, and also the global connectedness by this digital enabled breakdown on the classical barriers. And in the emerging market, you're really dealing with many chassis. You have a different type of boundaries. Is that with this really smart people, could that we redesign the boundary and the global connections to help those people can have the foresight to take the unfair advantage from those which does not have the insight, the digital connected world to be redesigned so then we can balance the vulnerability while still and the global capital growth?
Great question. And let me generalize it to technology, climate change, and demography is making the bimodal world more likely. So is it an opportunity to leapfrog, is what I hear you say, to leapfrog for emerging markets, or is it just a set of additional headaches? How do you think about?
Oh, well, I think that all the objectives and degree of planning in any one of those areas for any particular market, sovereign, or corporate is going to justify investing in that corporate or sovereign. I mean, those are the objectives. Those are the IMF, many central banks, not the US, for example, but clearly across Europe, climate change is very, very important. So coming in line, that's one reason you like, or people have liked in the recent past, Central and Eastern Europe. They're ahead of the game in terms of climate change, and that's an objective driven by the EU as a whole. So I think any emerging market that can accommodate that, investors will want to be a part of that growth.
Robert?
I was going to respond to the digitalization part. And I think the cool thing about digitalization as it relates to emerging markets is the transparency of information and the quickness of the transmission of that information. And that's always been one of the disadvantages in EM as an investor is, can you get good information and can you get timely information and reliable information? And so I think the digitalization, really simple strategies like, data mining social media to observe events is available today where it wasn't 5 or 10 years ago. And I could give one really quick example, which is the mining disaster that happened in Brazil last year. You could, for Vale, you could imagine 25 years ago that might not even have made Bloomberg or Reuters or what have you. It hit Bloomberg at 11:10. It was on social media at 10:50. It was out in the open, and it wasn't who happened to be at Bloomberg and who wasn't Bloomberg. It was all over social media. So I think there's all sorts of cool implications. Someone asked me once, "Aren't you worried about AI and digital and all that, and that the investing is going to become mechanized and what have you?" I'm actually really excited about it because we have this opportunity to get information, better information, faster than we used to.
And it is driving market pricing as well. So I completely agree with that. It's really very interesting. It's confusing at times too. It brings so many issues to you have to discern and delineate which ones are important. But if you can if some of those things create a market event and the fundamentals really haven't changed, it's an opportunity. So I've seen more pricing moves since this digitalization has come on, and you have to understand, have the fundamentals changed, or is this just a market move based on some new information?
Thank you. Other questions? Sir, over there. A microphone will make its way to you.
Is this on?
Yeah.
How does that affect a market like Chile with the events in the last month compared since 85, 97?
Not the way you would have expected yet. So, you know, we've seen the transparency, we've seen the information, and the market's had the ability to react, and it really hasn't. And I would say not yet. And I think that's similar in Peru. It's like, you know, we've been able to watch this unfolding of a constitutional crisis. You know, they have special prisons in Peru for former presidents, and I think 5 of the last, you know, presidents are in jail, on the way to jail, or shot themselves on the way to jail. You know, the problem is that's all available to us, and we see it. And in the world that we live in, this liquid world and this complacency world, it hasn't mattered. And I wish we had polling software, because if I described Peru and I asked you, like, what spread do you think that trades at? You know, most people tell me 6, 7, 800. Today it trades at around 40 over. And that's because of Chile, because Chile's at 35. And so Chile's like perceived to be the best credit in the market. That's the anchor for the compression trade, so to speak. And until that blows out, the rest of it stays the same.
Well, you picked on Chile. Let me pick on Hong Kong. How do both of you think about Hong Kong? Is it systemic?
I've just noted, so from a top-down point of view, in relation to Chile, I think the market is writing off this idea of some elements of security risk and political instability. So Hong Kong falls into this category. And Hong Kong, of course, has fiscal stimulus it can add to offset some of the economic pain. But it's really hard, it's increasingly difficult for me to price country risk as it pertains to political instability and some elements of security risk. So we talked about Saudi Arabia earlier today, half of the oil production being taken out, spreads are back to 125 or whatever they are, you know. So it's this idea of security and political risk are being discounted very heavily in the market, and I think that's one thing that's contributing to lower stretched valuations.
And you agree with that?
Yeah, I mean, I think in the case of Hong Kong, what's clear to me is that we've seen a change in the state of nature in terms of the way that Hong Kong was perceived as a safe harbor. And I think we haven't seen the full implications of that, but we have seen quite a slowdown in some things. But, 10, 20 years ago, it was like you could either go right to China, and there was advantages and disadvantages of that, or you could kind of play it safe in Hong Kong. I think that play it safe that's the change in the state of nature. And then back to digitalization, we're only talking about it because, not really because it's necessarily on the news, because we all saw it on Instagram first.
You're so modern. Twitter, Instagram, Snapchat.
I'm trying to keep up with you.
And probably to the extent that President Xi gets further involved in Hong Kong, that will be more of a reflection on China and what's going on in China, the power consolidation, than it will per se, I think, on Hong Kong over the near term.
One last question. Okay, I'll take it. Robert, and then I'm gonna torture you a little bit. Robert, you said it's gonna happen, and it is a 20% leg down in EM, if I heard you correctly. Is that correct?
I didn't say 20%. On average, in the past, it's been, I didn't say prospectively 20%, but yes, a dislocation will occur.
Okay, define first dislocation, because these days 1% dislocation is a dislocation.
So on average, the 9 of them have been down about 20%. So, either side of that, a material dislocation, not what people say today, like, wow, the market got wasted. It was down 30 bips yesterday or 2 or 3%. I'm talking about something meaningful, 10, 15, 20%.
Okay, and then I'm going to leave you a wiggle room. Within what period?
Can I ask my senior advisor?
Okay. Within what period?
Inside of 3 to 5 years, am I allowed to say that? I think I'll give the same answer I give to regime change in Venezuela. It tends to happen later than you expect, and then it happens sooner than you were expecting. But I would say that I think you'll see something meaningful in the next 12 to 24 months.
This is so countercultural. I didn't wear a tie because I thought I was coming to Greenwich and hedge funds and relax. Everybody's in a tie, including the hedge fund person. I thought Greenwich was supposed to be specific. You sound more like Washington, D.C. Foreign Service. You don't want to give us anything more than that? Okay, Rebecca, do you agree that it's coming?
It seems inevitable. It's been too much of a one-way street. We've had small liquidity events. We were talking about Q4 of 2018, something like that magnified could be coming. The global central banks are less and less capable of propping up the markets. I mean, it's eventually fundamentals have to take over. Earnings are slowing. The economy is slowing. That seems undoubtable to me. So unless
how
the
do you
earnings
plan,
are
given that institutionally you said it's very hard to buy when prices are just gapped.
yeah.
If you think it's inevitable, quote unquote, how do you plan for it?
Well, unfortunately, we're not in a great position to plan, but we would have to start allocating now toward emerging markets and being very specific about not where we want to be per se, but what we want to be in. Unfortunately, the fundamentals right now just, to me, don't justify it. So until I get a little bit more comfortable with China's next year and a half to 2 years fundamentals, until I get a little bit more comfortable with the U.S. election cycle, I think we're not going to be big into allocating ahead of that.
So, Robert, what's the
potentially.
structural solution to the behavioral problem of you don't allocate when you really need to allocate?
It's psychology, and you talked about it before, which is in your panel this morning. If we have these two different outcomes, why not just talk about it now? I mean, everyone's been belly aching for years that there's no volatility. I can't make any money with volatility, and then volatility comes and everybody freaks out and they hide out under the table. So whatever it is, and it has been happening already. It can happen on a idiosyncratic basis in different countries. It happened in Turkey last year. It's happening in Argentina today. It happened in Brazil. And I think you could have anticipated all three of those, and you could have underwritten it ahead of time. The psychology is like, yeah, wow, that 105-cent bond, if it ever went to 40, of course I would want to buy it. Then it goes to 40. It's like, no. Everyone takes the same amount, the same information. The difference between a bull market and a bear market is just what interpretation you put on it. But I think the way you have to set up, and you were talking with Jillian about, it's about psychology. It's going to happen, right? And just embrace the fact that it's going to happen, and embrace that as an opportunity, and underwrite that opportunity, and then stick with your plan.
Okay, we have 2 minutes, and the bit that I hate when I'm on the receiving end, but I love that I'm not on the receiving end. Okay, here's the rules. You can only say long or short. Okay? That's the only answer that's admissible.
We didn't talk about this.
Yeah. Okay, only 4 questions.
Ladies first.
You ready, or you can volunteer Robert first.
Oh, no, I'm fine.
Okay.
We'll see what I come up with.
U.S. recession sometime by the end of next year.
Is the answer high probability? What is the answer?
Yeah, yes, long, no, short, no.
Oh, yes, long.
Okay, Robert.
By the end of next year, 2020, yes.
Okay. Down 20% in emerging markets by mid-year next year.
No.
No? Okay.
Clarifying question, because emerging markets is a broad label.
In the emerging market, I'll give you the bond index.
Down 20% in the next 12 months?
Yeah.
No.
And in the EM equity?
Perhaps. Yes.
Okay.
Yeah.
I didn't give you the distinction. So bonds and equities.
I was answering bonds.
Okay, and equities?
I think there's fair evidence that earnings are slowing, so yes.
Okay, is Argentina a buy or sell?
That's a firm hold until better understanding of the strategy.
I don't remember firm hold being in.
So look, Argentina, there's a lot to love about Argentina on the medium to long-term basis, but I just need to be more comfortable with that. That's actually going to happen over the next 2 to 3 years. That's why we let people like this do
confidently,
that.
yes.
Okay. Sorry for this. President Trump gets reelected.
Yes.
Yes.
Join me in thanking our 2 panelists.